Welcome everybody and to this exclusive show on the IPO of Delhivery Limited. My name is Avinash and I welcome all the participants for this program. Friends, today we have us, Mr. Amit Agarwal, who is the CFO of Delhivery with us. Amit ji, welcome to the show and thank you very much for sparing your valuable time with us today. I would definitely like you to present your views and talk more about the company, its prospects and outlook going forward. So definitely, I believe it should be a very productive discussion, which would help all the retail investors who want to understand your company better.
Hello, Avinash. Thank you for hosting us and a very warm welcome to all the viewers.
So, Amit, my first question is basically, if you could give us some background about, how attractive is the infrastructure logistic market. We all know that delivery is a very large infra logistic player. In your perspective, what is the kind of outlook and what is the kind of growth opportunity which is presented to delivery over the next, say, 2 to 3 years? In your perspective, how big could be that opportunity and how can delivery, capitalize on this opportunity?
Avinash, if you look globally, logistics businesses are very, very large businesses. Large economies result into large logistics companies. In US, the companies like FedEx and UPS are multi-billion-dollar companies, $50, $100 billion companies. DHL in Europe is of a similar size and scale. In China, if you look at many logistics companies have come in size of $5, $10, $20 billion in last 10, 12 years only. Our country doesn't have any logistics company remotely of that size and scale. Delhivery, which is India's largest and fastest growing logistics company, is shy of $1 billion on a run rate basis of 9 months of FY22. In 9 months of FY22, we did 5,170 crores in revenue. And on a run rate basis, this will turn out to be about 7,000 crore, which is less than $1 billion. So you can imagine the extent of the large scale logistics company India needs if it has to compete with the global superpowers like US, China, and other European countries. India's logistics is a very scale sensitive business, as I said earlier, and delivery has been focused on building that scale by building a full suite of logistics services, be it B2C parcel service for e-commerce, B2B freight services for businesses, integrated supply chain services to combine warehousing and transportation services and leveraging data to optimize the supply chain, or cross-border services to enable the import-export trade. Delivery offers all the services using an interoperable infrastructure and technology, which means that we use same infrastructure, same warehouses, same transport terminals, same trucks to offer the same to offer all these services to our customers, which give us advantage in delivering superior customer experience while reducing our costs.
So I think Amitji, I got your point very well. I think Amitji, now tell me one thing. We've always heard from you, that delivery has been an asset light, kind of company. But I've been observing, that tech spends by the company have been consistently increasing. You all have been putting a lot of money on technology. So, going forward, is a significant amount of capital or money, is it going to be still, going to be invested in technology? I mean, is it going to be a large recurring expense for you? Or you think that, whatever expense you have incurred till now, that is going to actually give you a lot of multiple benefits going forward? So, some thoughts on the tech spending part, if you could clarify.
Very good question, Avinash. As I said earlier, logistics is a very, very scale sensitive business. And when you look at deliveries growth over the last 10, 11 years, for the first 7 years, we were mostly just focused on doing e-commerce logistics in India. And only in last 4 odd years, we have really scaled up the B2B businesses of delivery. And whenever you start new businesses and you start scaling up the businesses, you need to create the right operational tools, customer experience tools, your data products to optimize the decision making. All of those are required to scale the business, and that is the reason why delivery has been able to scale its business as fast as it has been. So these investments are the initial year investments relative to relative to what you see in their steady state. And our objective will be to gain operating leverage on these expenditures as the business scales further.
Okay. I think a related question to this is, Amitji, is that, your main expenses which we see on the profit and loss side is basically the freight and handling charges and the employee charges. These are the two most top cost components. So now I'm coming back to the same answer which you gave me, that, as the company's operations scale up, will the company get the benefit of operating leverage going forward? Because, that could be quite significant. So if you could add a little color on that and tell us.
It's a very important question again, Avinashji. If you look at our filings, our freight and handling costs have come down consistently over the period of time. In FY19, they were about 79% of our revenue, and now they are down to about 73% of our revenue. And this reflects in our adjusted EBITDA, which was about minus 11.3% in FY19 and is now minus 0.72% in the 9 month of FY22. It's a break even almost in the 9-month period. And once you exclude the quarter number combined together. So we are already seeing a significant operating leverage in last 3 years in our business on freight and handling costs. And the management's objective is to continue to drive this efficiency in future as well.
Okay. Amitji, if you can give us some color on the 9-month ended December financials, at least on the revenue, on the adjusted operating EBITDA level, and what is the non-cash charge which you have actually charged? Because I think that if you can clarify that, a lot of doubts from investors would get cleared. So if you could give us some key data points on the adjusted operating margin levels, the revenue, and obviously whatever non-cash items have been come on the profit and loss. So to give a realistic picture, if you can give us some key data points on the financials, that would really be helpful.
Sure, Avinash. Delhivery did a revenue of 5,170 crore rupees in the 9 month of FY22. When you look at our financials, it will show you a PAT loss of 891 crore rupees. But this 891 crores of PAT loss has several non-cash items which are not going to continue, or one-time items which are not going to continue. Once you adjust for these items, you will note that Delhivery's adjusted EBITDA is break-even for the 9 month of FY22. I will walk you through the 891 crore to the near break-even number. In our P&L, we have 300 crore rupee cost of fair value loss on CCPS conversions. When a company is privately held before going public and it issues CCPS shares, those CCPS shares incur a cost upon conversion into equity share. This is a non-cash cost and not a cost which is going to continue into future. So this is not related to BAU operations or BAU in future. There was areas to be paid to the management team and to the employees of the company based on certain performance targets that shareholders had set. And hence the company paid a one-time bonus of 178 crore, which came back to company in form of purchase or issue of shares by the company to the management employees. And that is also not going to continue. The compensation is decided by the nomination remuneration committee of the company independently. These two items will not come into future at all. The third item is the Esop expense. This is a non-cash expense. It does not affect the cash flows of the business. This affects the dilution in the business. But the important thing is we already have sufficient stock options on the cap table for next 5 years. So there is no incremental dilution for the shareholders in future for next 5-6 years either. So when you exclude all of these expenses, Avinashji, you will note that this is almost 700 crore of expenses out of 891 crores in the 9 month. And as you note, we are a very fast growing company, growing at 50%, nearly 50% year on year. We are required to invest in building capacity ahead of curve, investing in automation, hardware, material handling equipment, and robotics. And hence the depreciation is front loaded in general in our business. And once you adjust for depreciation and amortization, you will find our adjusted EBITDA for the 9 month period is minus 35 crore on a revenue of 5,170 crore rupees. The first quarter adjusted EBITDA was minus 51 crore rupees versus minus 35 crore for the 9 month. And when you hence look quarter 2 and quarter 3 in combination, you will find it is profitable at 16 crore for quarter 2 and quarter 3. So the objective for Delhivery is now how to continue the profitable structure it has achieved in quarter 2 and quarter 3, and how to improve upon it into future. That is the main objective for the management team now.
I think very well articulated, Amitji. Amitji, one small question which I wanted to ask and which is related to what we mentioned here. Like, from your presentation also, we get the feeling that if you take out the non-cash items, the operating EBITDA loss level has come down significantly. Now, going forward, at least in the next 1 or 2 years, what is the kind of aspirational level? Like, even if you don't want to put a number, to the operating margin number, can we assume that a large player like Delhivery can definitely outshine and significantly show a significant performance from its FY 21 and 22 numbers? Because what the market is not realizing is that the EBITDA margin is now going to improve, but some subjective kind of answer, if not a specific number related answer. So that could give little more comfort to the investors, because with a 35 crore loss, obviously once the revenue increases, the other non-cash charges don't come in. Can we assume that this number on the operating EBITDA side could be significantly more than what we have seen in the last 1 or 2 years? If you could just give a subjective answer. I know, I mean, I cannot talk numbers, but at least from the subjective point of view, will it be significantly better? I mean, in your perspective, at least in the next couple of years, with all the initiatives and all the strategies which company has been doing.
So Avinash, as I said, the non-cash charges, with the exception of Esop, there will be no other non-cash charge coming to the PNL, and then there are no ARs, etc., to be paid to anybody in future. On the operating leverage, Avinash, I want to highlight 2 data points. There are essentially 3 resources very important in our business: manpower, fleet, and the space we lease to run our operations.
Yeah.
Our revenue per person has improved from nearly 5.7 lakh per person per year to 7.5 lakh rupee per person per year between FY19 and 9 months of FY22. Our revenue per square feet per year has improved from nearly 2,800 rupee to 4,500 rupees per year. Both these are strong operating leverage. Our fleet costs have substantially come down as well, which you see in part of the freight and handling costs going down from 79% of revenue to almost 70 to 73% of our revenue. And management's objective is to continue to drive these efficiencies continuously and improve on its cost structure into the future as well.
Well, Amitji, I think very well articulated. Tell me in a very simple way that today, if somebody were to set up another company like yours, like just just as a kind of a example. I mean, in what way is Delhivery, little unique? What are the kind of key business modes which you all have now articulated? Because obviously, this is an infra logistic business. It's not very easy for any company to get in and significantly eat into your market share. But since you all are a large company, I'm quite sure several global companies must be competing with you. So tell me one thing, that what are the key, qualitative kind of data points which are not visible on the balance sheet, but which, are very important in your business, and which, you can say are the key competitive modes for you, so that nobody can come nearby and, take away market share from your company.
So Avinash, as I was saying, logistics require 3 ingredients: manpower, fleet, and land or building, basically, which we don't buy, we lease them. The real strength of Delhivery and the real focus that the team has had over the last 10-11 years, and it will continue to have on the same focus, is to build technology and automation hardware systems that will orchestrate these 3 things in the most efficient manner that is possible. This requires multiple things. The first it requires is a extremely efficient and reliant network to connect goods between any 2 points. Most logistics companies choose a hub and spoke model, which is sort of a static connectivity model where 2 points are connected to each other in a well-defined manner, and they do not change typically. Delivery follows a mesh network, which is a dynamic model which looks at what is the load distribution at any given time between multiple points, and then optimizes how goods should be routed between point A and B via either directly via certain intermediate points or consolidate load at other points. This is an extremely unique thing. The parallel to this model is a data packet or internet traffic routing model, which is infinitely scalable and a very low cost transfer model. That's number one. Number two is we have invested heavily into building data intelligence on last mile. If you look at our country, we do not have structured addresses in our country, like in US or UK or many countries where you can write a postcode, zip code, and you will reach a precise address. We have very unstructured address, and vernacular different languages can make it very complex to understand addresses. We have invested in algorithms that can read address in many different ways and transfer it into a geocode with a very high accuracy, which enables us to create very dense clusters of last mile deliveries using our technologies, and hence our delivery riders can be extremely efficient and have lot less burden on them, and they are much more productive on a whole on their operations. On the first mile and sorting, we have heavily invested into automation. We have more than 25 automated sort centers in the country with the capacity to sort more than 3.5 million packages per day. We have bought in many bag sortation systems, which are state-of-the-art automation systems, bag sortation systems in the country that are not been seen in our country earlier. And we have invested in 43 and 46 feet tractor trailers of Volvo, which are far more fuel efficient than what you see in the market, which are typically 24 to 32 feet trucks. So these are some of the key investments we have made in hardware and software in our business. Another very important aspect, Avinash, I would like to highlight is that Delhivery is a professionally run company, and it attracts some of the finest talent in the country. If our business has to grow to the scale that we aspire to, we need many talented and many smart people in our company. And we are a professionally run company where the stock ownership is deep into 600, 700 or more than that people in the company. So you have already 600, 700 owners working for you in this company, okay, who believe that this is their company and they work hard for that company day in, day out. So it's a very ownership driven culture, very professionally run company. And that is the reason why we have attracted talent from some of the best institutions in the country in our company. The last but very important aspect, Avinash, is our board. Our board we have had an independent board for last 5 years, and we continue to strengthen our board. Many of our board members, 4 out of 5 independent board members, have either run a Nifty 50 company or they are on boards of Nifty 50 companies. So that brings in a very high degree of corporate governance and discipline into the principles and the ethos of the company.
I think excellently articulated, Amitji. Thank you. Amitji, now let's come to one simple figure which most of the analysts and of course every business owner sees, and that is basically the cash flow generated. Like, possibly now we have said that operating EBITDA losses have come down. Possibly, numbers could get better now in the next couple of years. Hopefully, on the operating cash flow level, when could we see some better numbers? Because that is one area where, markets would obviously get it as a green kind of signal that, numbers are definitely going to get better. So I think, hopefully in the next 6 months or next 12 months, can we expect that, your operating cash flows, from the business get, generated on a very healthy level, so that, one can expect that, one may not look at the bottom line, but at least, not looking at non-cash charges from the operating kind of, activities of the company. Are you confident that maybe in the next 1 year or so, we could, see a significant positive operating cash flow without commenting on the number? I'm not asking you for a number, but at least, from a business standpoint of view, and as a CFO, can we say that cash flow from operations is going to be significantly healthy, in positive numbers, which should, be decent enough to give confidence to, the forthcoming investors?
Very good question again, Avinash. There are three things in cash flows for the company. One is how the profitability of the company is improving on a cash basis. And we calculated that adjusted EBITDA is the EBITDA which is based on the cash charges of the company, continuing cash charges. And that number has improved for Delhivery from minus 11.3% in FY19 to break even in Q2, Q3 of FY22. So we will continue to work on improving the adjusted EBITDA for the company. The second is your Capex that the company makes into its growth in the future.
Yeah.
If you again look at our track record of investment in hardware, we were spending about 10% of revenues in Capex 3 years ago, and this has now come down to about 7.5% to 8% in the current fiscal year. And we believe that as the company and the business continues to gain scale, we should gain efficiencies on this as well. It's very, I'll give you a sense of understanding where I'm coming from on this. When a business is growing very fast, like 55% year on year, if I lease any place, any space for business, then I would go for a 2-year, 3-year horizon, because the business is going to triple in that period, double to triple in that period of 2-3 years. And hence I need to keep changing my place of business very frequently. And hence you see the relatively high Capex in the initial years. But as the business gets more steadier, the place of business becomes more stable into future. So 10% of revenue as Capex has come down to already 7.5-8%. And as the business grows larger, we would expect this to become lower. The third part is the working capital. If you again look at companies' working capital track record, the receivable days were about 73 days in FY19, and that has now reduced to about 50 days in 9-month ending FY22. So there has been a significant improvement in this area as well. And going back, management's objective is to continue the path of improvement in all the three spheres, and that should hopefully result into the improvement in the cash flows for the business. And all this while we improved our adjusted EBITDA from minus 11.3% to break even in the 9 months of FY22. So that is the implication of fuel on the revenue. On the cost side, the implication is relative. First of all, we have contracts with our fleet vendors where we are able to manage the pricing with them on the fleet, on the fuel cost. Now, I spoke about Delhivery having 46-feet tractor trailers, which are extremely fuel efficient.
Yeah.
And hence the salience of the fuel cost in our cost structure is relatively lower than what most of our competitors would have in the market. Okay, because our trucks are more fuel efficient on a per kg, per kilometer basis. Similarly, we have deployed more automation in our facilities than all of our competitors that we think of have put together in there, and much more than that. We have parcel sortation systems, we have bag sortation systems, we have truck loading conveyors across most of our facilities, we have material handling equipment, and hence the our dependence on manpower is significantly lower than what other logistics companies would have. You may have seen before Diwali, many logistics companies flashing news, hiring many thousand employees just for 1 month, 2 month period. Delhivery doesn't need to do that. And despite that, it's the fastest growing logistics company in the country, right? And we don't need to do that because we have deployed so much automation in our facilities that we are relatively less dependent on manpower in our facilities. And hence the implication of wage inflation is also relatively lower for us in our facilities.
Fine. I think Amitji very well articulated again. Now, one question which has been troubling most of the analyst community. I mean, which again I would like to ask you on a very subjective note, is that if you compare all the companies in the logistics sector, whichever are listed like Mahindra Logistic or maybe TCI Express, without giving a direct comparison, what the general market community is feeling that the entire market cap of all these companies does not justify to the kind of valuation which Delhivery is asking. Now we are not going to talk about justifying the valuation here, but my question to you is that in what way is Delhivery so special that investors are looking at this company and obviously people are subscribing to the IPO. The valuation of one company itself is exceeding all the companies in this space. So is there any broad justification for this, or is it basically because the kind of infrastructure, logistic infrastructure which you have managed to show your growth numbers, the growth outlook, based on that, I think this number looks justified according to because finally you have to compare yourself with other relative players in the industry. I mean, in terms of technology, Delhivery is a great business. They have done remarkably well. But is there something so special about the company that it demands such a significant amount of premium? I mean, again, on a very subjective note, if you could, please help us in understanding this.
So, Avinash, if you look at our anchor list, you would see the name of some of the most blue chip investors subscribing to our issue in our anchor. And these are some very, very sophisticated investors with whom we have spent time explaining our business, and they have spent time in return with the bankers to understand the landscape better. And, and as a result, bankers came back with the certain price band or valuation range that they all were comfortable in. I would go back to the same point I talked about on logistics is a scale sensitive business. If you look at logistics companies globally, they are very, very large, and that scale allows them to have the efficiency that they are able to capture the market to the extent they have. And this is the scale in which Delhivery has invested and is now growing profitably from where it has achieved in the 9 months of FY22. I don't want to go into specific things, Avinash, about comparison with competitors, but a couple of things I want to highlight to viewers is that the EV by sales multiple of Delhivery, which I saw in some places as 5.5, must be adjusted for its cash balance at the end of IPO, because Delhivery is carrying substantial cash, and this cash is a significant war chest in for Delhivery in growing its existing business and inorganic activities Delhivery can take up. So we have a significant amount of cash post this IPO, and hence that 5.5 should be readjusted post cash basis to look at it at 4.6 EV by sales. Some of the other listed express logistics companies in this space are between 3.8 and 6.5. So Delhivery is closer to the lower end than to the higher end. And this is all despite the fact that Delhivery has been growing 50% year on year, while the other express logistics companies in the country, if you look at their growth rates, would be below the GDP growth rate of our country as well.
Exactly.
So investors who have participated in anchors are professional and sophisticated investors. And I believe that they understand that logistics is an extremely scale sensitive business, and Delhivery is investing in building that scale for future.
Anyway, thank you, Amit. I think Amitji, you've given a very nice answer to the question which I asked. Last question, Amitji, is that what would be your message as a corporate, as a company, to the new forthcoming shareholders? What is the kind of broad message you would like to give them? Because equity is a long-term asset class. We believe that wealth creation genuinely happens if you invest in a company for long term. So at least for the new incoming shareholders, especially the retail side and the HNI side, what could be the broad message the company would like to say that they could offer decent risk reward to them and take care of them on a longer term kind of parameter.
Delivery operates in a very large non-discretionary market of over $200 billion in logistics, and it's going to grow to $300 billion if India has to achieve the $5 trillion economy mark. Delivery is an asset-light business, and hence Delivery does not deploy capital in land building and very, very little amount in fleet. And that's the strategy Delivery will continue. And Delivery will continue to invest its money in building high quality infrastructure, including automation and material handling and software and data products. We will continue to invest in building data intelligence products, which will allow us to make intelligent decisions, deliver superior customer experience to our customers and their customers. And we intend to continue to grow profitably as we scale. Delivery has proven that it is a natural consolidator by acquiring companies like Spot On Logistics Limited, India assets of FedEx and Aramex, and acquiring significant stake in Falcon Autotech, which is one of the leading automation companies in the country. And Delivery's management team is extremely entrepreneurial, and the ownership is very, very deep and deep and wide across the company, with over 600 or 700 employees having stock options in the company. Thank you for hearing our story, and we wish you all the best.
Thank you, Amit ji, and thank you very much for patiently answering all our questions. So, viewers, I think we had a very good conversation with Mr. Amit Agarwal. I think hope everybody will like it, and kindly, if you like the video, please share it. We would definitely like that from your side. So, thank you very much, Amit ji, and all the best.
Thank you, Avinash.